students. Today we'll begin with a new chapter, that is assessment of companies, computation of total income. So a company is required to pay tax on its total income at a flat rate. What I mean to say is, just take the example of individuals. In the case of assessment of individuals, there is an exemption at the initial stage. For example, if the income does not exceed 2,50,000, there is no tax at all. Then 2,50,000 to 5 lakh, 5%. Then 5 lakh to 10 lakh, 20%. About 10 lakh, 30%. That way, depending upon the income, different rates are applicable. And exemption is there. So also in the case of HUF. But this type of exemption is not applicable in the case of assessment of companies. Whatever may be the income, even if the income is 100 rupees, tax is levied. So no exemption whatsoever. Okay. For the purpose of assessment of companies, the understanding of the meaning of the company and various types of companies is very essential. Okay, now first we'll understand the meaning of a company. So here, it's not the general meaning we are studying, meaning under the Indian Income Tax Act. Under section 2 subsection 17 of Income Tax Act 1961, a company means an Indian company. What's an Indian company we'll study subsequently, or any body corporate incorporated under the law of foreign country. That means it is a foreign company incorporated outside India, or any institution, association or body, whether incorporated or not, and whether Indian or non-Indian, which is declared by general or special order of the CBDT to be a company. CBDT means Central Board of Direct Taxes. Okay, thus a company means an Indian company or a foreign company or any institution, association or body, whether incorporated or not, whether Indian or non-Indian, which is declared by general or special order of the CBDT to be a company. Now let's see what's an Indian company. An Indian company means a company formed and registered under the Companies Act 1956. So it must be a registered one, and it is registered under the Indian Companies Act of 1956. It includes a corporation established under Central or State Act, and any institution, association or body corporate which is declared by the Central Board of Direct Taxes to be a company under section 2 subsection 17. A company, corporation, institution, association, body will be treated as an Indian company if its registered office is situated in India. So it is called by different names like a company, corporation, institution, association or body, and that will be treated as Indian company if it is registered, if its registered office is situated in India. So that's about Indian company. Then what is domestic company? Domestic company means an Indian company or any other company which has made prescribed arrangements for declaration and payment of dividends within India as per section 194. In the case of companies, there will be profit normally, and the profit will be distributed among the shareholders in the form of dividends. But the arrangement should be made for the declaration and payment of dividends within India only. Then it is called domestic company. There are certain requirements which must be cumulatively together to be satisfied by a company in order to be treated as a domestic company. Now, what are those conditions or restrictions? The share register of the company for all shareholders should be regularly maintained and at its principal place of business in India, and in respect of any other assessment year, at least from 1st April of the relevant assessment year. For the shareholders one register is maintained that is called share register. So that includes name of the shareholders, the distinctive number of shares held by them, number of shares held by them, types of shares, paid up value. All these things are recorded in the share register, and it should be maintained at the principal office. In the case of memorandum, there is a domicile clause where the registered office of the company is situated. So normally it is a principal place of business. So it must be maintained at the principal place of business in respect of any assessment year, at least from 1st April of the relevant assessment year. Then the general meeting for passing of accounts and declaration of dividend in respect of relevant previous year should be held only at the place in India. So there are different types of meetings like board meetings, shareholders meetings, and then class meetings, creditors meetings, etc. And under shareholders meeting, again there are different types of meetings: statutory meeting, general body meeting, special meeting, or extraordinary general body meeting. Now, general meeting, in the case of general meeting, what I mean is the general meeting for passing of accounts. Accounts must be approved by the shareholders, and the decision regarding declaration of dividend, that also should be passed in the general meeting in respect of the relevant previous year, and that should be held at the place in India, only at the place in India. So it should be held in India. General meeting, passing accounts, account must be approved by the shareholders, and board of directors may recommend the dividend, but finally it must be approved by the shareholders. Therefore, the meeting held for passing of accounts and declaration of dividend must be in India. And one more thing is dividends declared, if any, should be payable only within India to all shareholders. It should not be paid outside India. So if these three conditions are cumulatively satisfied, then it is called a domestic company. Then what is a foreign company? A foreign company is a company which is not a domestic company. Very easy way of defining a foreign company. Okay, now we'll know about the residential status of a company. In the case of individuals, there are three types of residential status, like a resident, second one ordinary resident, then non-resident. Resident, not ordinarily resident, and non-resident. In the case of company, only two types of residential status is applicable. Number one, ordinary resident. Next one is non-resident. So not ordinarily resident status is not applicable in the case of company. Let us see. Determination of total income of a company depends upon its residential status during the relevant previous year. A company is said to be resident in India in any previous year if it's an Indian company. Secondly, its place of effective management in that year is situated wholly in India, entirely in India. What is that place of effective management? It means a place where key management and commercial decisions, primary important decisions that are necessary for the conduct of the business of an entity as a whole are made. So very vital decisions, very important decisions, that is management and commercial decisions, if they are taken within India, then we say that it is a place of effective management. So its place of effective management in that year is situated wholly in India. What is a not ordinary resident? A company is never a not ordinary resident. I told you in the case of companies, only there are two types of residential status. One is ordinarily resident or resident in India. The other one is non-resident in India. So it cannot have a status like not ordinary resident in India, unlike individuals. A company which is not resident according to the aforesaid conditions, that is these two, it's an Indian company and its place of effective management in that year is situated wholly in India. If these two conditions are not satisfied, then it is called non-resident company. Okay, now let's go ahead with the computation of total income, because always tax is calculated on the total income, whether it is individuals or HUF or whatever it is. Tax will be calculated on the total income of the SSE. So in the case of company, also the total income is calculated similar to that of individuals or HUF. To be specific, it is calculated like this. First, we have to calculate income under each head of income after deducting losses and allowances brought forward from earlier years. For example, say income from house property. There are certain deductions like standard deduction, then interest on loan, so that way. And even in the case of other heads of income, there are certain deductions. Similarly, losses brought forward from the earlier years should be adjusted to the extent possible and as permitted in the law. So ascertain the taxable income under each head of income after deducting the losses and allowances brought forward from earlier years. So first, taxable income under each head of income should be calculated. Then it must be total. So salary income is not applicable here in the case of company. Only 4 heads of incomes are applicable. So taxable incomes computed under each head should be total, and then you will get gross total income. Then you have to go for general deductions under section 80. There are several deductions here like ATG, ATGGA, GGB, IA, IAB, ISC, IB, BA, IC, ID, E, JJA and JJA. All these deductions you already studied in an earlier chapter. Therefore, I am not going to explain all these things. You already learned these deductions in detail. Okay, after deducting all these deductions depending upon the applicability, it's not necessary that all the deductions are applicable to a company. Depending upon its business, certain deductions might be applicable. So after deducting these deductions under section 80 from the gross total income, what you get is the total income. On that, you are calculating the taxes. Okay, what are the rates applicable to the computation of tax on total income in the case of company? See, there are special incomes there are certain incomes where special rates are applicable, like short-term capital gains on securities, provided security transaction tax has been paid. And in this case, 15% tax is leviable. It is a special rate. Then, if there is a long-term capital gains, a flat rate of 20% is applicable on long-term capital gain. Then, if there is any winning from lotteries under section 115BB, 30% tax is levied. It is levied, and not only that, there is a TDS. Then, on the balance of total income after calculating the taxes on short-term capital gain, long-term capital gain, and winning from lotteries, whatever income remains from out of total income, on that tax will be calculated at the rate of 30% if it is a domestic company. So that is why differentiation is made between domestic company and foreign company. In the case of domestic company, the rate is 30%, and in the case of foreign company, rate is 40%. And in the case of domestic company, the rate is 25% if the turnover in the previous year 16-17 does not exceed rupees 250 crore. So thus this is applicable only to 2016-17 previous year, provided the total turnover does not exceed 250 crore, and the rate applicable in that case is 25%. Normally, in the case of domestic companies, on the balance of total income other than short-term capital gain, long-term capital gain, winning from lotteries, etc., is 30%. Alright, in the case of foreign companies, it is 40%. So now you are calculating taxes on total income. On that, we have to calculate surcharge. surcharge is nothing but tax on tax. So surcharge rate is 7% if the total turnover exceeds rupees 1 crore in the case of domestic company, and it is 2% in the case of foreign companies. So if the total turnover exceeds 1 crore, surcharge is 7%, 7% on taxes, and in the case of foreign companies it is 2%. But if the total turnover exceeds 10 crore, in that case it is 12%, and in the case of foreign companies surcharge is 5%. So surcharge is calculated on the taxes. Alright, then there is one more tax which is to be levied. We call that cess, that is health and education cess. This is calculated at the rate of 4% on the total of tax on total income and surcharge. So it is 4% on tax plus surcharge, if any. Surcharge might be there, may not be there, depending upon the turnover. So that way it is calculated. And the due date of filing income tax returns is September 30th. So in the case of individuals it is July 31st, whereas in the case of companies it is September 30th. Of course, sometimes the date of filing the income tax returns might be extended, like current year due to Corona. The date of filing the income tax returns has been enhanced to November last, and now further it is enhanced to January of 2021. So unless otherwise stated, the date of filing the income tax returns in the case of companies is September 30th. Now, sometimes if you choose section 115BA, then the tax rate is 20%, 25% on income of certain domestic companies. In the case of certain domestic companies, the rate of taxes are 25%. This is with effect from assessment year 2017-18. But this is not generally applicable. It's not a general concept. So it is applicable only if certain conditions are fulfilled. Otherwise, the rate is 30%. But if you opt for section 115BA, then the rate will be 25%. But there are certain conditions to be fulfilled. For example, the assessee is a domestic company, not engaged in the business other than the manufacture, production, research or distribution of such article manufactured by it. The company is set up or registered on or after 1st March 2016. Total income is computed without claiming additional depreciation and deductions under section 10EE, 32SC, 32AD, 35CCC, 80H to 80TT, not being 80JJEE. Total income is calculated after claiming depreciation, but the rate cannot exceed 40% and without adjusting brought forward loss. Moreover, such a loss will not be carried forward. The assessee has this option to pay the tax at 25% to be exercised before the due date of filing income tax return, that is September 30th. Once the option is exercised, it cannot be withdrawn subsequently. Tax on capital gain shall be calculated at the rates applicable under section 111A and 112. Remaining income, that is including lotteries, etc., is taxed at 25%. Alright, next one. One more thing. If a company, domestic company, opted section 115BEE, the tax rate is 22% plus surcharge 10%, not 7% or 12%. Here it is 10%. And health and education says no change, 4%. And this option is available with effect from assessment year 2021 and without claiming prescribed deductions and additional depreciation. If company exercises its option under this section, then it is not liable to pay MAT, minimum alternate tax, under section 115JB. Then further, there is one more option, tax on income on certain new domestic manufacturing companies. This is applicable in the case of manufacturing companies with effect from assessment year 2021, and this is under section 115 BAB. This is another type of domestic manufacturing companies, and they can opt for tax rates under this section 115 BAB. What does that mean? A new domestic company which has been set up and registered on or after 1/10/2019. Remember, it should be a company registered on or after 1/10/2019. It should be a new company. It has commenced manufacturing before 31st March 2023. Okay, may pay tax at 15% plus surcharge at 10% and health and education cess at 4% at its option if it fulfills prescribed conditions. So this is the latest one. So the rates are very low, the rates are very competitive, but such companies should fulfill certain prescribed conditions, and that should be a new company, and it should be registered, set up and registered on or after 1/10/2019, and should commence its manufacturing activity before 31st March 2020. So that's about the types of companies, and then computation of total income, and also computation of taxes. So in the next class, we are going to begin with solving some problems based on these provisions, like computation of business income, computation of total income, computation of taxes, and all these things. Thank you till then.